All right, we're live. Dottie, good to see you.
Thank
How
you.
you
Good to
been?
be here.
Good
Been
to have
great,
you.
and especially today because I like talking about my stuff.
I love it. I love it. Looking forward to talking with you. It's one of our industry's great subject matter experts on an issue that critically important to housing finance right now, affordable housing solutions. And yeah, looking forward to get into it. So yeah, thanks for joining us.
You bet.
And you're in Southern California.
In Southern California, just north of Los Angeles and Ventura County.
Do you ever go to any events at the Ronald Reagan Library?
Of course, I'm a member of the Ronald Reagan Library. Anybody that's out here that wants to have a tour, let me know and I'll take you through. You can even get on Air Force One and walk through it from Ronald Reagan
Oh,
days. Yeah, it's a cool thing.
cool,
Huh.
Yeah, they have
cool.
the airplane suspended in this huge room overlooking some of the more ranch ranch property that's out here. And in fact, my business partner owns one of those ranches that is just below the Reagan Library. So it's a fun place.
Love it. Good
It's
to see
hard to
my good.
believe it's been over 40 years since he was president.
Yeah, unbelievable, huh?
Time flies when you're having fun. So good to see
Oh,
my good friend Bernard in the chat. I Emergent. Bernard and his wife Laird, former guests on the show.
yeah.
Their platform, I Emergent. And all
They're,
right,
they're
well,
due to come back.
soon, absolutely. Yeah, we're going to queue
Yeah.
that up in the first quarter of next year. So absolutely. So all right, well, let's go ahead
I
and get.
remember seeing Laird on your show.
Yeah, they were great. They were great. So.
Yeah, yeah.
All right, let's go ahead and get into it. My name is Rich Swerbinsky with Onward and Upward Consulting. This is the big picture presented and sponsored by our friends at Depth. Nearly 2 decades of helping fintech firms get noticed and noticed fast in the mortgage lending industry. And if you are a fintech, you have to move fast and need a PR partner that can keep up with that pace. And Depth, man, they do such a good job. So many happy clients performing strategic communication, brand management, public relations services for participants in the mortgage industry. And if you need your story told, they do an incredible job. And you can find them at depthpr.com or get a hold of Rob Wright and we can get you connected. And hopefully Sean is saying he's hearing an echo. Anybody
Yeah.
else hearing an echo? No?
Not me. I
Sean,
can mute
maybe
myself.
Sean, maybe you just drank too much last night, Sean. All right. It's just Sean. All right. You got us freaked out for a second there, Sean. I'm not in my home office, so I was a little worried that maybe we were having sound issues. So, but
Rich, where are you?
I'm in lovely Cincinnati, Ohio, at the Fifth Third Bank annual sales meeting. So, yeah, got a chance to spend some time with the team and did a presentation to them just a couple hours ago on, yeah, just using LinkedIn, social media to win, to grow, to recruit. So they just acquired Comerica Bank. So Fifth Third going to be the ninth biggest bank in America when that is in the rear view. So yeah, some exciting times for 5-3 as they move.
Are you gonna snag some Skyline chili for the drive back?
I'm not a Skyline chili fan, but we did have some good Cincinnati barbecue last night at Rheingeist Brewery. So I got my local flavor fix. So, and of course Rheingeist, the great brewery, Truth IPA. Might have thrown down a couple of those last night as well. So, but there we go. And as always, join my esteemed colleague and co-host Rob Chrisman. Rob, great to see you.
Yeah, I can't believe everybody's turning against Skyline Chili. Here I am just trying to help a local company and, you know, you lash out against them. Faith was just on lashing out against them. I don't know. I don't know. Anyway,
Dot,
yeah, good to see you too.
Skyline, good to see you. Skyline Chili, Dottie, yay or nay?
Yay. Yes, to any chili.
Okay, yay to any chili. So, and our guest today A very, very decorated background in our industry. In the critical affordable housing space, she spent over 11 years as Fannie Mae's Director of Housing Impact, 20 years at Bank of America as their Senior Vice President of Affordable Housing, and the last 10 or so years on her own, consulting with companies all across the industry on affordable lending initiatives and products with her firm, Specialty Housing Products. It is Dottie Sheppick. Dottie, thank you so much for joining us today.
Yay, I'm so happy to be here. Thank you. Thank you so much, Rich. Thank you, Rob.
Looking
Yeah.
forward to getting to it. And Rob, a couple days ago, I was looking at the news blotter, and it was very sparse, which has been not the norm for us this year, but a bevy of news these last few days. Of course, we're still in a government shutdown. Loan Depot in another lawsuit, this time them waging the lawsuit against West Capital Lending. They're on the other side of one of those lawsuits that was filed a month or so ago. Free Vantage score for everybody. We predicted this one, as a response to the FICO play. Now the Bureau's proclaiming to give away Vantage score. And then today, a couple pieces of very interesting news that just broke. Russell Vogt came out and said that he's shutting down the CFPB in 2 or 3 months. I don't know if he has the right to do that or the legal authority, but that came out today. And then also very interestingly, and tied into some things we want to talk to Dottie about today, FHFA put out a request for input on their strategic plan for the next 5 years, looking for industry input. You have until November 5th to do that. High level focus on deregulation, fraud detection, and things to help the supply side of our industry. But also very interesting. Bill Pulte, no tweets about this. Also, Bill Pulte not quoted in the press release about this RFI. So I found that very interesting. And Rob, I'd love to get your thoughts, but this RFI, it seemed like they were just, you were open about your fears they would maybe move too quick with Fannie and Freddie and its potential impact. And I think right now what this kind of says is like we've got to get this right. We've got to get this right. They probably don't want industry feedback, but feel it can help and is necessary. So I view this as a positive sign. But what say you?
So going back to the CFPB, um, I, I I I continually underestimate the administration's ability to do things without any congressional input or any input at all. So for Russell to come out and say that he's doing away with the CFPB, it doesn't surprise me. Uh, I think that the quickest way to do something like that is to cut off all its funding. And if you don't have any money, you can't operate a department. But I don't think the last time I checked, it was, you know, it's a congressional decision about closing an entire department. The last department I believe that was shut down was the I think it was Department of Energy under Carter, maybe. And that shows how long ago that was. So, I think that, in my opinion, Rich, we need a CFPB. We don't need the CFPB from the last administration, but we need a CFPB. And if you look at the name of the CFPB, which is to protect the consumer, the agency does a lot of other things just besides mortgage. And so that'll be, of course, interesting to see what happens there. With regard to the request for public input, call me old fashioned, but I still call it the FHFA like you did. I think Bill Pulte is striving to call it the U.S. Federal Housing. He just calls it U.S. Federal Housing, which I think is a move towards bringing in FHA and VA and USDA under that umbrella so that he would be running all of that. You're very astute to notice that he wasn't on any of the press releases and so on, but I didn't notice that. I don't know if it means anything or not, but I when I first read it, first looked at it, the the request is for develop a strategic plan for 2026 through 2030. And I'm skeptical that we can make plans that far in advance with regard to uh, the agencies, for example. I think the press release said, you know, overseeing Fannie Mae and Freddie Mac for the American people, which is nice, and overseeing the Federal Home Loan Bank system, which is in its mandate, and then just effectively manage all federal housing operations, which I think includes FHA and VA and USDA. So some people seemed that, given the emails that I received, some people view it as a power grab uh, by uh, by the group. I think that it is mandated to some extent, and it's nice to have public input and industry input. I don't know if it goes a long way in terms of determining what they do, and Dottie's probably in a better position to answer that than I am, because it seemed like, and I keep going back to what happened in May when Bill Pulte addressed the national secondary in Manhattan, and then 2 days later, President Trump uh, countermanded, or you know, said something that was different than Bill Pulte had said 2 days earlier. So nice to have public input. Whether it actually uh, applies or sticks, I'm a little skeptical about that. Dottie, what do you think?
Well, of course, I read it right away and determined right away that I was going to make comments. Um, but just thinking of the whole strategic plan as a whole and more goals, it's like, okay, so now the GSEs will have affordable housing goals, duty to serve goals, strategic plan goals. Um, and where does that get us, especially in the execution of all of it, right? That's always been the issue. Um, but I like seeing some of the stuff, whether it was in the road to housing or this new strategic plan. I like some of the stuff that refers to accountability. And I like that because I think, particularly in this administration, by the way, when it comes to affordable housing, the only thing we're going to get to keep are the things that we can measure and that we can report on that have been successful. Um, if you look at the proposed budget for this year, it proposes to eliminate home and CDBG funding, which offers a great deal of funding for down payment assistance programs at the local level. Um, but in the first Trump administration, he suggests the same thing, and then it turned around and they were funded at a similar level or greater level than they had been in years past, because the advocacy groups were ready and willing to show how they have been successful. Same thing with the tax exempt bond programs for HFAs. But getting back specifically to the strategic plan, the one part that interested me was objective 2.4, number one, support creation of initiatives, develop new housing supply. And that's what I've been pounding the ground about these days is I think there is a way, a solution, one solution that can help create new housing supply. So I will be making comments on that, and then otherwise, who knows where it goes, right? Who knows? With all these other things, all these other goals and affordable housing initiatives for FHFA and the GSEs, who knows where it goes?
Yeah, even the most you can get staunch Trump supporters to say is that it's entertaining. You know, you just never know what's going to come our way. And the I've always made the point, and Rich has heard me say this dozens of times, that you've got trillions of dollars of mortgage-backed securities out there, and hundreds of thousands of investors in those securities, and millions and millions upon millions of borrowers through Fannie Mae and Freddie Mac. And so you don't want to just tweet out something boldly new without a lot of input. But you never know, right? Never know.
You hit upon a point that I think is so important that people forget about, and that is the mortgage-backed securities and the investors on those. And so whether it's affordable housing and you're worried about whether or not the people are going to lose their homes and what kind of solutions you have for that, you have to be mindful of the investors of MBS and international investors as well as US investors and the impact on them and the part they play in investments for things like pension funds and people's retirement. So yeah, such an important point not to miss.
Yeah. So you've been doing this for a while, and I have my opinion, which I'm going to keep to myself momentarily
No,
for a
go
little
ahead.
bit.
I've heard it before.
No,
Go ahead.
no, no,
I've
no,
heard
no.
it.
Do you think that we are in a housing crisis?
Um, so is the administration going to announce a housing crisis, housing emergency? I don't know. I think we are in terms of where the rubber meets the roads. In other words, consumers are in a housing crisis. Um, and it's coming from a lot of different a lot of different segments. So, and you've talked about this on your show many times, what's happening with the insurance, right? People are going to lose their homes, not because they can't afford the mortgage payments, because they can't afford the increase in insurance and taxes. And so, and if we start to see softening of markets, which I think we are, then they're not going to have an exit strategy that they thought they could have. So I think from a consumer level, there's not enough inventory, there's not a house to buy, there's not going to be, because we are not going to let go of our 2.99 or 3% mortgages. We all know that. And so I think there is, from the standpoint of inventory available to purchase, first-time home buyers, from that standpoint, yes. What's going to happen in terms of the softening market, still to be determined, but I think we're beginning that for sure.
Yeah, I continue to make the point that you can't point at the mortgage industry and say, this is your fault. Affordability is your fault, by any stretch of the imagination. And you're right. I mean, when your insurance costs double or triple, or when your HOA becomes insolvent or gives you a special assessment because the rebar is rusting in your Miami condominium and they need everybody to pony up, $50,000 or whatever it might be, the affordability is certainly a problem. I just don't call it a crisis. I mean, I've seen
Mhm.
other things throughout my tenure in this industry and not even this industry, just in life, that seem to be more of a crisis than what we're seeing now. I would say that interest rates are where they are, and affordability is a big problem. Obviously, we have not kept up wage wise with doubling or tripling of a price of a house. If you look at the Fannie Mae and Freddie Mac loan amounts that throughout history, I don't remember what it was when I got started, but it was much much lower than
Yeah.
the conforming loan limits where they are now. And so, but obviously wages haven't quadrupled during that time period, and so a lot of people have been, I won't say left in the dust, but yeah, looking around saying, holy smokes, I don't make enough to be able to afford houses where they are now, which leads into your specialty, which is affordable housing. And do you
Mhm.
think the current administration that affordable housing is a will will uh, will do well in the next 3 or 4 years?
I think they'll continue to do as well as they have been under this current administration. And I'm judging that based on his prior administration. And as I said before, there are groups like the National Council of State Housing Agencies. So they're an advocacy group that represents all the state housing finance agencies. And the state housing agencies have advantages to offer good mortgage programs, including down payment assistance that other lenders, investors don't have. And again, because NCSHA has done such a good job in collecting and managing data, they have been funded at the same level or greater level every single year, including during the Trump administration. So, they offer 35 to $40 billion a year in first-time home buyer home ownership loans across the country, and that hasn't settled. It hasn't diminished over time, and the funding hasn't diminished over time, and that's because they are successful and can prove it.
Yeah, it's certainly an interesting topic, and Rich and I have talked about, the lack of inventory and so forth, and I would say that inventory levels have picked up. Now they may not be at starter home prices, and I don't even know what a starter home price is anymore,
Yeah.
or where they are. Uh, but I wrote about it today. I know that President Trump talked about Fannie Mae and Freddie Mac and builders and possible builder related solutions, and that's easier said than done. I wrote about it today, some of the issues that may come up if you put too much reliance on builders to solve this problem, because builders are sitting there looking. I mean, builder inventories have picked up. They're offering discounts, they're offering treats for people who buy their homes, good loan programs and so forth. And so things aren't great in the builder segment. So yeah, it's a problem. Once again, I wouldn't call it a crisis. I'd call it a problem with plenty of potential solutions, but there's no, I keep telling people we need Rich as a housing czar, housing dictator to come in and say, do this, do that, do this, do that. Because it is a very disjointed problem, especially when you involve local politics and insurance companies and condominium associations and the bond market and Fannie Mae. I mean, it's a wide ranging problem.
Agree. And I would like to be Rich's assistant when he becomes a housing
You're better
czar.
off, you're better off getting a job, trust me. I could be your assistant, but Dottie, the supply, I didn't get a chance to read the strategic plan today. The supply side piece of it, you know, like bullet points, if you read it, what was in there, and then you had noted that you were going to submit comment, and would love for you to share the nature of what, you're going to share on comment with them, because I think it's really relevant.
Well,
Maybe
thank
she
you.
hasn't prepared it yet.
Um, no, actually, I have. So the comment that they're going to get from me is the comment that they've been hearing from me. It won't be the first time they've heard from me, and there'll probably be people who'll see my comment and roll their eyes and say, of course. And so for a few years now, through different avenues, I've been pounding the ground about the need to have a one-time close construction product that can be sold at closing to the GSEs. And what I've learned through my work and investigation is that if you read the charter for the GSEs, which I've done because I'm such a geek, not everybody does it, but that Fannie Mae could buy loans, could buy new construction loans without the construction being completed. Freddie Mac's charter is a little more clear in that they cannot buy mortgage loans where there's not already a home built, where there's not an improvement. So we've been really, mostly thinking about Fannie Mae in this enhancement to their product line. And here's why. So today, if you're a borrower and you're going to build your own home, you might go buy the land and you'll probably get a balloon, right? 3 to 5 year high interest rate land loan with a balloon. And then once you get ready to build, you'll get a construction loan. So you're going to go through a complete credit review again and get a construction loan. and it's going to be at a higher interest rate. And then once the construction is done, you might get a mortgage. So you go through another credit check. So a one-time close loan through a builder could finance that construction. So it eliminates that financial carry cost for the builder. It eliminates the numerous credit checks for the consumer. And it also reduces reliance on warehouse lines for the lender. So today they buy home style, right? Fannie Mae buys home style. That's their rehab loan. And so they buy it at closing and the construction has been complete. And the property may or may not be occupied. So they buy that loan. So they can buy construction loans at closing. And I think with that financial relief, what I hope, and I've talked to more than one of the really big builders, with that financial relief, then perhaps they could buy at the lower end. I mean, build at the lower end. And even if they can't, they can still build cheaper, which is going to help the entire industry. In addition to that, when you think about the whole construction lending or construction loan industry, we need more consistency in documents. We need more consistency in some of the compliance, disclosures. We need more consistency in the disclosures. Some of the work that my business partner and I've done for lenders shows that for example, the construction loan agreement that they're using falls short of protecting the lender, protecting the borrower, and protecting the builder, just because it doesn't have enough language in it related to potential breaches or potential defaults. And in addition, it doesn't do enough to describe the relationship between the contractor, the lender, and the borrower. So there are a lot of things that could be made, I think, that could be improved through having a GSE involvement in construction lending and buying that loan at closing. So that's what they'll hear from me. It won't be the first time they've heard it from me. And I want to give big kudos to the Mortgage Bankers Association. A few years ago, they developed the Construction Lending Working Group, and they agreed that this would be an enhancement that could help with or provide, one solution to the inventory issue. And they've been writing letters to Fannie Mae and Freddie Mac, and they've been communicating with them. They have ongoing conversations, including conversations this coming week. And so the MBA has been a great leader in trying to move this forward. So that's what they'll hear from me. And it won't be a surprise from, yeah.
Do you know of any jumbo construction to perm investors out there?
Such a good question. And I'm trying to find out right now, but yes, there are. And when you say construction to perm, are you talking about the end mortgage loan, or are you talking about a one-time close? The end mortgage loan.
And mortgage loan. And mortgage
So
loan.
yeah, that would be the standard investors, right? Because the property's already built.
Oh, you're right. You're
And
right.
so
You're
that's
right.
yeah.
I'm more on the construction side.
On the one-time close, there are a lot of banks that do one-time close jumbo loans. And I'll just give you one example in Colorado. A couple years ago, we were hired by a law firm that was representing a big bank, one of the biggest. And they were being sued by 10 borrowers in Colorado. And the reason why is because they had gotten one-time close loans, construction loans from this lender. And these one-time close loans, they can pay for the land, they pay for the construction, and then they convert to a mortgage. So that's what they had received from this lender. And they all had the same contractor. Well, this gentleman, the contractor, took all their money and ran with it and spent it. And so that wasn't at issue. He was convicted. He was charged and convicted. He did jail time. But then the 10 borrowers said, well, who can we get money from next? Let's try the lender. So they sued the lender. This lender was awesome in terms of their documents because they had a construction loan agreement that very clearly protected them. They did not choose that contractor. The borrower chose the contractor. We've seen documents where that's not clearly laid out. In this case, it was. We were hired to rebut the expert witness testimony that the plaintiffs had hired, and we killed him. And we killed him, thank you, in part to the lender who had the right documentation in part. We probably would have anyway, but the lender won by summary judgment. And so, yes, there are lots of banks that are doing one-time close loans, and there are some that are doing a really good job, and there are some that probably have some gaps in how they're originating those loans. But one-time close is not new. When I worked for Countrywide umpteen million years ago, I ran one-time close. We were doing primarily jumbo loans for executives and doctors and professors, but we had a very robust one-time close product that was being sold as whole loans to jumbo investors.
This is the big picture presented and sponsored by our great friends at Depth, depthpr.com. If you are a fintech looking to have your story told, the best in the biz, in the worlds of strategic communication, brand management, public relations services, check them out at depthpr.com. Dottie, we've talked about this before on the show, and I've talked to you about this. The FHFA was very close to rolling out a C2P, one to close C2P product. It was like 2018 or 2019. I remember I was running TMC. We were a strategic partner of theirs. They were soliciting our input, and we were, working with them hand in hand to, really, give them guidance on the development and potential release of the product. Then the Mel Watt sexual harassment stuff happened. He got thrown out. Calabria ended up coming in. Pandemic happened not long after that, and it gets all swept under the rug. So there's some precedent for doing that. With regards to this administration, would they do something like that? I talked about this last week. I don't think they could do it if they want to take the GSEs public, as they've noted. I just think it would be too, it's additional risk for the GSEs, obviously. And, they're terrified of raising rates if they take the GSEs public. So, and I don't necessarily think this administration is passionate about affordable housing, but they're definitely passionate about winning the midterms. And you could just tell by the way they're talking, affordability, affordability, affordability. Besson is just banging the drum on every damn cable news show he's on, talking about housing in almost every one of these conversations. Curious to get your thoughts on how you think this may play out. Now we're in an RFI till November 5th, so we're not going to get nothing new, no new GSE news till probably December 1 at the earliest, I would guess, but you'd probably know better than me. Just your thoughts on that whole dynamic, using the GSEs as a utility. They could lower G fees. They could roll out a one closed C2P. There's a million different things they could do to stoke housing overnight, but it's all contradictory to taking the GSEs public and the sell high payout, 30 billion for just selling 5% of them. It's tempting. Your thoughts on how all that may play out?
Yeah, it's interesting that you said that about them looking at doing this, 7 or 8 years ago, because honestly, many more years ago than that, probably 20 years ago, before the housing crisis, um, and when they were still, I mean, they are still today wholly owned by stockholders, even though they're in conservatorship. But at that time, it would have been more in the environment that you just described. And guess what? The Fannie Mae had agreed to roll out a one-time closed construction product. And we had already developed all the policies and procedures. We were live to go. In fact, there's a 20 or 25-year-old press release where I'm quoted about, boy, I can't wait. Yes, Fannie Mae's going to roll out this construction loan. This is going to be great. And then they decided not to do it. Why? I never found out. But so yes, they've probably thought about it continually, probably not the same people. There's probably one or two people left there from those days, but but I think it is a good solution. And I think the more the administration learns about it, whether it's somebody through somebody like Bill Pulte and um, some of the other big builders, um, I think that they would, I would think this is a good idea. And the reason why is while you say there's risk, that risk is so totally manageable. And talk to the lenders today that are offering one-time close, and they'll tell you that they make boatloads of money and they don't have the same kind of issues that people think about. I see in the chat the question about the average borrower cannot handle construction projects, and they're 100% right. um, and in this scenario it would be the builder, it would be a standard development with the specs and the plans already laid out, and the builders managing the construction project. So it's really not the same as a builder built as a buyer building their own home without that kind of infrastructure. Having said
Mhm.
that, I will say this too, as far as managing both sales and operations for renovation products and one-time close, the lender has to have the right infrastructure to support it. And if they do, if they have the stomach for it, is the way I'll describe it, they can do a great job and make good money. They have to have the right people there so they can take the call from the borrower when the borrower gets in trouble and wants to know what to do next. Um, and there are a lot of one-time close lenders today that offer, cradle to grave borrower booklets on here's what you'll need to do, here's what you'll need to know. I think we can do it. I think we can do it right. And I think the administration, if they get the right people in the room, would say this is one solution. And if for no other reason politically, because it supports the builder community. And let's face it, supporting the builder community is politically wise.
But what about the rate part of it, right? I think the nightmare scenario for Fannie Freddie and potential IPO investors certainly is we write all this, say they roll out a C2P product tomorrow, people go gangbusters, right? And C2P at 6 3/8, 30-year fixed, closes in 45 days. You don't have a home for 7 months, and rate inflation spikes. Rates are 7.25%. And the GSEs, they can't put these loans in the securities until the home's built. So you have, you know what I'm saying? Like they would have to mitigate, right, that
Yeah.
interest rate risk. The same way, like when I worked for banks, that was our nightmare scenario. It's like all these C2P close and they're 3/4 in rate underwater. And you either got to put them on the books and mark them to market at 98 cents in the dollar, or you got to sell them at a 2 or 3 point loss.
Yeah. So guess what? I don't, today rural housing has a one-time close loan that can be securitized.
Hmm.
And so it can be done. And to your point, that definitely would help with the interest rate risk that the GSEs might hold. And so I guess you guys, I'm sure you guys all know David Batney, right? So David Batney is a part of our MBA working group on the construction loan working group, and he has submitted his thoughts, his ideas from a capital market perspective on how those loans could be securitized at closing.
Interesting. Interesting. Something to keep an eye on. And it's yeah, I think this is a big topic to keep an eye on. And it feels like after this RFI period is over that yeah, we're probably going to get some kind of major announcement on the future of the GSEs not long after that. So be interesting to see how that all plays out. So me personally, I think Palti's going to be out if I had to guess. I'm,
Yeah,
I'm making that prediction right now that he's gone by Jan 1. And they'll
yeah,
either put Calabria back in there or somebody else that's going to play a little bit nicer. Housing is too central, I think, to everything that's going on. And it's central to the voters' hearts and wallets right now. And I just think we've seen, remember Trump did the same thing with the AG psychopath nomination, that guy down in Florida. Like he put him out there and I think with Pulte, it's like, we gotta wage this war against Powell. We're gonna have to gut some employees at the GS. There's a lot of dirty work, and I could
Yeah.
see Trump, Pulte's come in and done good from Trump's perspective and all that stuff, but you may need more of a bridge builder. I don't know. Your guys' thoughts on that? Pulte's been a lot quieter lately. His social media has been tamped down ever since Besson tried to beat his ass. It just seems like, that there's he's definitely been more pushed into the background because I don't think he's going into the background willingly himself. But I don't know, just an observation.
Yeah, I mean, I hear from industry buddies that what you said could happen, right? So I don't know. I mean, time will tell. I would like to answer one of Rob's questions, and
Mhm.
he didn't ask it today,
Mhm.
but he's asked it before. And it has to do with lenders origination housing finance agency loans, right? And so if it's okay with you, I just wanted to comment on the state of the housing finance agency industry today. So, we have more than 50 state housing finance agencies, and as I said, they offer programs where lenders originate anywhere in most years between 35 and $40 billion in loans. So it's not chump change. It's not, the best in some ways, but when it comes to affordable housing, they are a unique and successful partner.
How much do they
Having
do a
said
month,
that, they
Don?
a year they do 35 to 40
Oh,
billion
okay.
a year.
Yeah, I was gonna
A
say
year.
30 billion. I thought you said a month. Sorry. It's like,
I
whoa.
wish, right? But yeah, no, 35 to 40 billion a year. Um, and they've heard it loud and clear from the decades of all of them being individual, basically investors. And so they all have their own guidelines, they all have their own income limits, they all have their own sales price limits. But here's how one way things have changed dramatically. When we were at such a long, low interest rate environment, it became financially not advantageous to offer tax exempt bonds. So I know a lot of people, even senior leaders, call everything housing finance agencies do as bond loans, but they're not. In the old days, they were, and it was a great product as well because tax exempt bonds can offer a rate, an interest rate, 30-year fixed rate, a point and a half below standard market. In this lower interest rate market, what they started offering was standard TBA product. So it's market rate TBA. They're leveraging the TBA market to offer loan programs that have a higher rate than tax exempt bonds. But the HFAs have unique advantages, such as the ability to offer premium pricing to create down payment assistance loans. So, as instrumentalities of government, the conventional as well as FHA allow them to premium price a first mortgage loan to create funding for a second mortgage. So today, HFAs offer at least 80%, maybe 90% of their production offers a down payment assistance loan for the consumer. In addition to that, they will sometimes offer a lot of other things. Sometimes you can partner with a grant. So in terms of how much does it cost to get into your first time home these days, if you go through a housing finance agency, you're much more likely to be successful. Having said that, a lot of people worry about the income limits, for example. My goodness, in California, the income limits, are like 300,000 in some counties. So I think it's something to look at again. And what the TBA program has brought to the HFAs is less onerous guidelines. In a tax exempt world, you have to go according to the IRS rules for sales price and income limits. And if you go above that limit, that loan is not saleable to the HFA. And as a lender, you're stuck with it. And it's going to be sold at a really junk price in a tax exempt bond program. If it's a TBA funded program, you can probably get an exception from the HFA and still sell them the loan. It's a standard loan. So I think it's important for lenders, especially, to know that and to ask that question. Participate in those HFA programs, man. It'll widen your menu. It'll give you a lot of visibility in terms of the HFA will advertise you and your loan officers, provide their phone numbers. So there are a lot of advantages in offering it, but know where the program is being funded, because you need to be much more careful with your manufacturing quality in a tax exempt bond program than you do in a TBA program. I'll tell you a little story from many years ago. I got a call from a gentleman who had just been hired, him and his team, in a retail branch, and he said, where do I get all the information on affordable housing? So I pointed him to our databases and whatnot. And I said, well, let me ask you, how much production do you do in this program? Well, Dottie, I don't really do a lot of production, but I start a lot of conversations. And so, he was doing a lot of first time home buyer work. And there has been a lot of consistency brought across state lines. So I think if you haven't looked at it for a really long time, give me a call. Let me tell you some of the things that have occurred that have brought consistencies to the affordable housing industry, including loan documents. Yes, Rob.
So, so when you say your database, I mean, where would people go? Is there a website that you can say over the call here?
No, that's when I was still working for a lender, and the guy asked me, where do I get all the
Uh,
information, right? And so I had
but
the
your
database at the time. But
organization,
having
what
said
you're
that,
doing. Oh, go ahead. Sorry.
there are databases available. Probably people have heard from Down Payment Resource, right? They're a national database that categorizes about 2,500 programs. Freddie Mac has their own database today. They have about 1,000 programs. The National Council of State Housing Agencies has what they call HFA 1. And so today, I think they have like 30 states that gives, in a huge spreadsheet, all of the details across their programs, so you can see where states align. So there are databases that can help with the whole process.
Thank you.
Mhm.
Her name, Dottie Sheppick. You can find her on LinkedIn. Dottie, what's your email address for anybody that's listening that wants to maybe learn a little bit more about, some of the initiatives and products that you've been mentioning here?
Yeah, what I'm going to do is I'm going to type it right here, because
I got it.
D Sheppick.
Actually,
So it's
I got it.
D Sheppick. Oh, you got it? Okay, you can do it then.
But say it
It's
because
D Shep.
most people listen to the podcast. So
Whoops, I just put in my error there. But yeah, thank you, Rich. You've got it right. So yeah, D Sheppick at dtspecialty.com. I'll give you my phone number as well, 805-630-5081. I'm a consultant. I'd love to have to work for anybody out there, but because I'm such a geek about it, I also do a lot of free consulting.
love it. This was great, Dottie. Thank you so much for coming on.
Yes, thank
Really,
you.
yeah, drawing off
Yes, you
your
bet.
experiences in this field and some of your current intel on things percolating behind the scenes, and really enjoyed the conversation and having you on the show today.
Thank
Yes, thank you
you.
very
I loved
much.
it. Thank you for the opportunity. It was great. I love you guys. As you know, I listen to you every week.
Love it, love it. And thank you also to our attendees today on the live. If you're listening on the podcast, join the live, chrismancommentary.com. You can go to get signed up. We're live every Thursday, 3 to 3:45 p.m. Eastern, and always a fun time consuming the show live. So hope everybody has a great rest of the week and weekend. We'll see you next Thursday. Rob, Dottie, have a great rest of the week and weekend, and we'll see everybody soon.
Thank
Take
you.
Thank you
care.
so
And thank
much.
you to Depth. Bye.
And thank you to Depth. Take care, everyone.
Thanks to Deb.